Well, good morning, everybody over here, and to Meggin, Thwing, Eastman, one of our speakers in America, and good afternoon to everybody in Italy who is watching the webinar. My name is Simon Howard, and I'm delighted to be moderating this session on social risks in the light of COVID. By background, I am a fund manager, and until recently, I ran the UK Sustainable Investment and Finance Association, and that's the UK version of what in Italy is the Forum per la Finanza Sostenibile, run by my friend Francesco Bicciato. I'm delighted to be involved here today. Our session today has three fine speakers. Meggin Thwing Eastman is the Global ESG Editorial Director and ESG Research Director for Msci. Meggin has written widely on social themes, notably gender, human capital more widely, and the opioid crisis. Corrado Gaudenzi is head of long-term sustainable strategies at Eurizon, and Corrado wins the long service prize today. He has been at Eurizon for 23 years now. He uses a stock-picking approach on a portfolio mixed between Europe and global stocks, and he describes himself as a contrarian. Interesting. Our final panelist is Wim van Hyfte, who has been global head of ESG investments and research at Candriam since 2016. Prior to that, he was a quantitative analyst and fund manager at Candriam. Wim has a PhD and is a visiting professor at Solvay Business School in Brussels. Now let me set the scene briefly before handing over to Meggin. I'll start with the basics since we want everyone to be at the same place and on board. I've already used the phrase ESG several times, and that stands for environmental, social, and governance. In this session, we're going to be talking about the S, social issues. Now, throughout my time in sustainable finance, S has been the overlooked one of the three. People now understand the crucial value of climate and environmental issues to financial outcomes, and they know that corporate governance is crucial. But social, what does it mean? It's never been entirely clear, and it varies by country and by culture. And that variation is something we just don't see, for instance, in environment. But S is important to the citizens, to our fellow citizens, to the end investor. It is important to the clients of the financial advisors on today's webinar. It's important to the pension fund and insurance beneficiaries and savers of the fund managers listening to us today. At UKSIF, we used to do opinion polling each year, and social issues such as tax, such as employment, they were always scored as very important by the British population. Indeed, I have seen polling where social issues were ranked as more important than things like climate change, for instance. Fund managers know that something has changed with COVID. I did a series of interviews over the summer with British-based fund managers for a forthcoming report, and overwhelmingly the managers said they would be looking at their process and at their thinking in the context of COVID and of S. That may come up as we talk. And funds with good S scores, funds which invest in companies with good S scores, seem to have performed well during the crisis. That too may come up as we talk. So now is the time for the industry to think more about S, about what it is and how it is defined, how it's measured and how it is used. And we will look at some of that during our session today. So I'm going to ask Meggin Thwing Eastman to start. Meggin, I think you're going to show us some slides. I'll hand over to you now, Meggin.
Excellent. Thank you very much. Just give me one moment. There we are. So thank you Simon for that introduction. It's great to be here today, even if it is 6 o'clock in the morning in Massachusetts. I should start by saying for anyone who's not familiar with MSCI, where I work, that we provide indexes, research, and investment tools to institutional investors all over the world. And we believe that investors everywhere should be looking at sustainability issues as part of their decision-making process. And of course, that includes social issues, as Simon was just describing. And here we're sitting deep into the second wave of COVID-19 in Europe and in America, into this year of exceptional challenges. And I think we can probably agree that social issues have come pretty starkly to the fore for a lot of people. There is a lot to try and make sense of here. As Simon said, these are sort of squishy issues. There's a lot of variability. But if we just take 2020 so far with COVID, we've seen lockdowns and shuttered businesses with people out of work and going hungry, a lot of loneliness and uncertainty. We've seen a massive global experiment in working from home that a lot of us here are probably participating in right now. And in fact, on a personal note, I'm supposed to be based in London now, but because of the pandemic, I'm still here back in the States, haven't been able to move yet. We see danger lurking in jobs that used to look pretty safe. And we've also seen an energized movement to end racial injustice and explosions of social unrest, especially in the United States, but not limited to that. And underlying all of that, of course, there are over 1 million people dead around the world, and we're all going about our lives with this drumbeat of worry in the background. So that's a lot to cope with, but research can help. And so in that spirit, I'm going to share with you a few of the questions that our ESG analyst team has been asking and some of the things that we've learned so far. So I'll start with the world of work, which has been turned on its head in a lot of ways. The ILO calculated that the first half of this year, just through June, saw the loss of around 400 million full-time equivalent jobs around the world. And some have come back since then, but the headlines this fall have still been full of fresh layoff announcements. Airlines, theme parks, movie theaters, even tech. And the social impacts of this are obvious and they're worrying, but there are investment risks too. Job cuts are often necessary for a company's short-term survival, after all. But if you're concerned about long-term value creation through human capital, through the people who do the work and have the ideas, you want to know how well thought out the execution of those job cuts are. So well-considered restructuring practices like outplacement and retraining might indicate a more strategic approach from the company, in addition to helping cushion the blow for workers, of course. Here on this slide, what we see is the prevalence of those kinds of programs among companies that had major layoffs in recent years, large companies, global companies. And as you can see, they're not as common as you might hope. Now, for those of us lucky enough to remain employed, this has been a year of radical changes. And if you look closely at this guy, you can see that not only is he wearing pajama pants with his suit, but it looks like his laptop is sitting on a child's high chair, which is a makeshift setup that might resonate with more than a few people in the audience here. And then there's the question of how well prepared his employer was for this big shift. We've seen that some companies and some regions have managed it much more seamlessly than others, and some have struggled. If we take Japan as an example, the corporate culture there has been famously dependent on FaceTime in the office, long hours. But you can see here that nearly half of the companies in the Msci Japan Index had no existing telework systems before the pandemic. None, nothing. So they undoubtedly had some scrambles that ensued in order to get everybody set up in order to do this for a while. And so the question there is, which companies will have seized the opportunity to really rethink how they operate altogether? Some are undoubtedly just trying to survive, and this is not limited to Japan at all. Some are making bold pronouncements that may or may not stand up to the test of time. Those companies saying, we're never going back to the office ever. And then some are thoughtfully questioning long-held assumptions to try and sort out what to keep and what to throw out. And that's a question that we're going to have to just kind of wait and see how it goes and who the winners and losers are in the end. For work that has to be done at work, companies now face an array of new concerns about keeping their workers and their customers safe. Jobs that used to seem safe, like grocery checker or receptionist, suddenly don't feel so safe anymore. And for investors, the old ways of measuring and understanding health and safety risks, like injury rates, accidents, aren't enough anymore. What you see contrasted on this chart are the top 10 industries with the biggest health and safety risks as measured by two very different metrics. On the left, the blue bars by fatality intensity, which is a traditional way to look at it. And then on the right with the green dots by how much contact with other people is required day to day on the job, which is not something that we've much thought about in this context before 2020. Despite its challenges, though, working from home is in many ways the luxury option. A lot of lower skilled workers this year have found themselves facing a choice between unemployment on the one hand or risking infection in exchange for low pay on the other hand. What we've done here on this chart is to plot industries by the average infection risk, which we proxied again by the required proximity to other people on the job, against the percentage of the workforce with a college degree, university degree. The results are pretty stark in this distribution. And you have to imagine that the lived disparities here are pretty stark too. Do you remember Occupy Wall Street? I do. With social unrest already heightened, these kinds of disparities, increased inequalities, are worth keeping an eye on. So with that, as a segue, a little bit of a segue, let's take a look at what's happened since another sort of social movement has turned its attention to companies. Demands for racial equality leapt to the fore as the spark of George Floyd's death here in the US met dry tinder in the disproportionate impact that the pandemic has had on people of color, both physically and economically. As people filled the streets, employees and investors turned to companies with demands that they do more. 2 years ago, we took stock of workforce racial diversity reporting by US companies and found that most disclosed nothing at all, even though by law they have to report this information to the US government. But this fall, 34 big companies all at once, including names like Target, Chevron, and Verizon, as a group committed to make those reports public, in a sign that there might be starting to have some effect. There have been a few others who've come along since then as well. But to move the needle on actual inclusion is going to take action, not just transparency. So things like changing how recruiting is done, setting targets for sourcing diverse talent and including people, dedicating senior attention and responsibility to making improvements. As of June of this year, only about a third of large cap companies globally reported doing any of those things. But these are the sort of concrete measures that we already see employees, investors, and diversity advocates asking companies for. And those that choose to implement them, it might give us an indicator of how a company approaches social change in its operating environment, which is an important thing to think about, even though this is one example, a big example, but it's an example in a context where there's a lot going on. So all of that leads us to the big question, which is, what does all this mean for investors? So I'm going to finish up here with a couple of highlights from some of our recent research that yield a bit of insight into that question. I've extracted this analysis from a paper we published earlier this year called Deconstructing ESG Ratings Performance, where we picked apart the different types of issues, so not just ESG ratings, but E, S, G, and individual issues underneath that, like labor management or carbon emissions. And we did that in order to better understand the individual relationships of these issues with financial outcomes, because they don't all behave the same way. Among the findings there, we saw that companies with low S scores, the ones doing a poor job managing social risks, they're about twice as likely to experience major stock price drawdowns as their peers with good S scores over time. And the difference, the biggest difference was seen there at the edges, the largest types of loss. So those kinds of drawdowns could follow scandals or lawsuits or accidents or other kinds of abrupt events, all things that are just less likely to happen if you're giving these issues the management attention that they require. Companies with good S management also steadily accumulated better financial performance over time. And what we're looking at here is over several years, especially when we look at workforce issues like health and safety and labor management. And the flip side of that, of course, is that the companies who are not doing a good job saw a steady erosion of their value over this time, even if they never experienced a single major event that would cause a big drop in their stock price, like on the previous chart. So in short, all of the social stuff matters. Simon did a good job in the introduction talking about how these days we better understand corporate governance and environmental issues. Social issues are a little harder to grapple with, but we're starting to see more concrete evidence about how they can matter to companies' value creation or erosion over time. I'm going to end with this photo that I took recently near my home here in Western Massachusetts, and the observation that while we can't know what the future will bring in these crazy, uncertain times, things are very unsure looking into the future, but the ESG framework, environmental, social, governance issues, as a way of looking at things might be uniquely well suited to help us ask the right questions at a time like this. I'm going to stop there and hand it back to Simon, who I believe is prepared to do just that and ask us some good questions.
Yes, I'll start with you, Meggin, just seeing the slides for real, as it were. That last slide showing the cumulative performance on various factors. It is interesting, isn't it? I introduced by saying that S is not well defined, and we don't really, sort of have a full, well, we don't have as good a grasp on it as some other issues. But your slide was suggesting quite long-term positive returns to good S factors, wasn't it? I mean,
yeah.
How long do you think it's been going on? Could you hazard a guess?
Oh goodness, that's a little bit harder to say, for sure. It is a tricky question, and honestly, here we're hampered by the data history. So Msci probably has a longer data history on these things than just about anyone else, but it's still limited for a wider universe of companies. So I would venture to guess that it's not brand new, that it wasn't introduced in 2015 or 2014 or whatever the first year on that slide was, but we don't have as much comprehensive data for enough companies going back further to be able to do the analysis. So that's something we're going to see play out over time more. But, if you think back, I mentioned Occupy Wall Street, that takes us back to the financial crisis or just after the financial crisis. I would certainly hazard a guess that was significant, financially significant for at least some companies. Just as an example.
I always think, my job used to be to pitch sustainable finance to a wide variety of people, and I was always worried that we were going in with the latest big thing. So I think the fact we've got data series going back 5-6 years and potentially even further is very important. And financial advisors can say to their clients, this is not a new thing. We're not just, jumping on the latest bandwagon. Here is some, good data. Very interesting. Okay, so what we're going to do now is just have a kind of round table discussion on some of the aspects which have been raised. And Corrado, I'm going to pick on you first, if I may. I'm going to come to you just to kick us off. I mean, we've heard about the number of job losses, some really interesting phrases. Working from home is a luxury. What are you seeing? What are you thinking at Eurizon about these social issues and linking them to investments? I mean, basically, what are you doing in the light of what we're seeing?
Well, thanks for the question. I think that the pandemic restrictions policies have really hit hard labor-intensive industries. You said loss of jobs in many sectors, such as we see retail, transportation, hotel and restaurants. And so this increasing social inequality after the pandemic policies. So we see that public regulators have to respond to the social risks, delivering policies that keep strong connection now between environment and social answer. And in this way, they define also the profile of winners and losers in the private sector. For example, in EU, we have the Green New Deal. The Green New Deal was launched some years ago, but now has to face the critics of pandemics. So the ambitious target of targets of reduction of CO2 emission. Now the answer is how we can achieve this ambitious target, avoiding the sad remake of the Yellow Jackets in France, for example. And the answer of the plan is to incentivize more energy efficiency in building. That is one of the main sources of CO2 emission, and at the same time is one of the more directly, indirectly labor-intensive activities. So building renovation, building decarbonization, I think it's the most powerful answer that combines strong environment and social impact. So this clearly define who can be winners and losers. For example, in the US, we are approaching the Biden presidency, and in the Biden agenda, there is a lot of green jobs. And the social impacts that we see are concentrated mainly in three fields. Largely, they depend on how much the Biden will be supported by the Congress, but we can expect a large initiative of public spending in infrastructure renovation, that is needed in US because they have very old infrastructure. But what we can expect is that companies that will benefit from public spending will need to comply to improve the labor rights. And for example, we'll have to pay at least $15 per hour. Another topic that will be under the light will be environmental justice. There are disadvantaged communities that often suffer from both environment and social inequalities, environment degradation. So we can expect that at least 40% of the clean energy incentives will be dedicated to disadvantaged communities. And we can expect also that the polluter will be held accountable. Another field of job to increase job creation probably would be to incentivize the domestic sector to become world leader in electric vehicle and electric battery production. And this is another solution that can combine environment and social impact. So in a nutshell, I think going forward, a regulator both in Europe and US will have to support the technical solution that create a good intersection between the answer to environment and social needs. They don't have to be treated as standalone because they are very closely interconnected, in my opinion.
That's very interesting. Your point that the beneficiaries of public sector contracts, and presumably this will be globally, will have to address social issues, because a lot of those contractors and the heavy industry aspects of infrastructure will of course be those sectors which Meggin highlighted on one of her early charts on the left, the steel and construction with a bad record. So not only will they have to respond to things like Black Lives Matter, they're going to have to make up ground they're behind on already in terms like health and safety. Thim, can I just ask you to comment on that, sort of changes in the EU approach in the light of COVID? Is there anything you're thinking of at Candriam you can share with us?
Thank you, Simon. Thank you for having me, first of all. What I think is, what we've seen is that thanks to or due to the pandemic, like Corrado and also Meggin already mentioned it, that is clearly shift in the mindsets of regulators, investors across the globe. And that we all have become more sensitive to that issue of incorporating social aspects of a business into the way we deal with businesses, the way we invest, and the way we set up a regulation. And I would say honestly, it's a little unfortunate that it took a global pandemic to make regulators, to make investors realize that the social part is important. And has anything changed in that regard? My answer would say no, not really. I think it has clearly changed the behavior of regulators, of investors. But I think society has changed long before that. And Corrado already mentioned it. We've seen obviously les gilets jaunes, yellow jackets. We've seen obviously Occupy Wall Street. So these are all clear movements within our society, clear change in our society that highlight what is actually going wrong, actually. And I think when you think about that famous expression about you think about the end of the world, it articulates what taxonomy is working on, that climate part, but we think about the end of the month. So that was kind of the famous expression of les gilets jaunes. I think it nicely encapsulates the real issue that we currently face. Regulators, and I dare say investors too, maybe not the investors that have had that traditional focus on sustainability, where they mostly have incorporated other stakeholders in their investment philosophy. But I would say the more traditional part, more traditional investors, including regulators, including governance, have always avoided that social part. And the climate part was the most easy to address because we're talking about economic activities. We talk about long-term objectives and the trajectory to that, for example, net zero carbon economy. The fact that we have never touched upon that social part, although in the preamble of the Paris 2-degree Paris Agreement, it was clearly mentioned that the social part should be considered, but it was just about that, just one sentence. The fact they have never gone beyond that is simply because that social issue has always been perceived as very ethical, very moral. And it gets us away from what investors have always been focused on financial materiality. We talk about banks, we talk about investors, we talk about companies. It's about the bottom line. So whatever we do, we should incorporate what impacts earnings, sales generation of companies. And I believe that we have massively overlooked that S part in that regard. And I think Meggin made a very important point there. And obviously Msci is one of the data providers that has probably the longest history in terms of data available. But to me, what Meggin actually shows is simply an articulation of what has been going on for decades. I believe that what we've seen over the last 10, 20 years is a material shift in the way companies are being valued. Where we saw in the 60s and the 70s, physical assets being very important to a company, what we now see, and obviously we have seen that with the TMT bubble, but certainly with internet becoming more important, the value of a company is more and more driven by intangible assets. And why we call it intangible? Because we don't report on it. Look at employees. What do you see in an accounting statement? An employee is reduced to one line, the number of employees in a company. We don't report on governance. We don't report on diversity. There's no obligation to talk about pay gap within companies. So there are a lot of missing elements in the reporting of companies that, first of all, allow people, including regulators, society, investors, to judge how companies are dealing with that. And the second point is, it doesn't allow us to identify whether that S part has played a role in the most successful companies in the world. And I believe they have played an important role. People that have treated their employees in a fair way, people that have included supply chain issues. We've seen that in the COVID crisis. Supply chains have been massively disrupted by COVID. Companies that have close ties with their suppliers, subcontracts, whatever, have performed better than others. So there are very material, and when I talk about material from an investor perspective, my perspective is also my clients, material financially in terms of alpha and risk, there are very important S issues that drive long-term performance of companies, both for fixed income investors, hedging risks, and for equity investors, better alpha generation. The thing is that it has never been identified in research, and I think I'm glad that Msci and Meggin showed this. It is very important. One additional point I would like to make here, because we were talking about regulators, when I said, like, has the pandemic changed anything? Yes, it has clearly affected the behavior of investors, some at least, but no, some, a lot of investors, those sustainable investors that we had before, they were already acquainted with the S taxonomy, I would say, the social taxonomy, but it has clearly affected behavior of governments and regulators. They have always had that focus on climate, but what I do believe is now is what's on the table is not only social issues from an individual, an independent perspective, but it's also the fact that when we see how climate, how a circular economy is impacting our economic activities. When we talk about impacting our economic activities, we also talk about impacting the social part. It's not anymore separate, although the Paris Agreement made it feel separate. it is not separate. If we have a shift in our economy to more sustainable activities, it impacts employees across the board. We're talking about, in Meggin's chart, it was pretty clear, you're talking about construction, you're talking about infrastructure, we're talking about the energy sector. When we steer clear of those polluting activities, or we push companies to consider S, it means that those companies need to transition. So it highly impacts the social part of a business. So these are all reflections I'm making, but I believe is the future, and what lies ahead is certainly that investors, regulators, governments will more and more be challenged on how they deal with this in light of the climate challenges that we face. So it becomes much more interconnected.
Can I just challenge you on one thing, Wim? I think you said a few minutes ago that S was part of very successful companies. But I think what we've seen in the pandemic is some of the technology companies race to extraordinary valuations, and they are frequently challenged on S. I mean, are they the exception? Are you thinking of a different tranche of companies who are doing well with good S, are you?
That's a very good question, but you need to be careful in taking a few cases, because let's be fair and honest, we're talking here about the FANGs, and all the acronym has been expanded quite a bit now with all these kind of Internet of Things companies, major companies that are dominating our markets and clearly impacting valuations across the board. We need to be careful not to take those few case studies and think that this is how globally the picture looks like. Clearly, those FANGs, those very big IT companies, tech companies, have serious issues from a social part. I'm not going to mention specific names here, but I know the press, we've seen it in the press. There are definitely things that we need to deal with. But across the board, I would say that if you look across sectors, and you take distance from those few case studies that are true, I admit, that dominate the S&P 500, that dominate the MSCI world in terms of their weight in the index, and so the overall performance of the market, except those few cases, I would honestly say that across the board, across all industries, and Meggin actually showed it, what we see currently is that those companies integrating suppliers, integrating employees, and really caring between brackets. I don't want to over-exaggerate it, but at least consider it as an important stakeholder of their long-term success, have clearly outperformed. And I can confirm what Meggin actually said. We've seen it not only in equity, we've seen it in fixed income too. Those companies dealing with those stakeholders have outperformed the market. And maybe one remark that might resonate.
I want to bring Corrado in on it.
Yeah,
so
sorry. Go ahead.
Okay, Corrado. So I mean, this is we haven't discussed this question. I'm sorry to throw it at you, but is your experience in your portfolio echoing what Wim is saying? That if we put aside the big technology companies, in general, you are seeing good S companies doing well, but perhaps less the household names like the FANGs. Is that your experience as well?
I think that we need to consider that the big tech companies, because they are so big, they have a good, an important role in the increase of the equity index. So they dominate the scene because of their model, the winner takes it all. But then, so for alpha production, having bet on those very big name would have been successful. But if you look at the median performance, the average performance of companies, the picture is quite different. If you look, for example, to the most simple things to look at the ESG index provided by, for example, Msci ESG leaders, there's no real bet on this topic, on FAG, on winner takes it all. You see a very good performance. So, and the S is one of the most important factor on this. So I fully agree with Wim. S is good in detecting companies that have a long-term view, because right now, I think it's completely different from the past, where the value was in the asset. Now, the most important asset are the people that works in the company. So having people committed to the mission of the company is really strategic for success.
Yeah.
We on our side, we have developed a new metric to evaluate also the human capital management, because as we said, we have very few information available. There are no big standard for the companies to report on how to manage people in their jobs. So we have developed the new source, new metrics that goes into deep in order to understand the sentiment of people that work in the companies compared to other companies. And we saw that companies that have people that are considered engaged in the company, on average, this company perform well on a fundamental basis.
That's really interesting. Meggin, I'll bring you in at that point if I can. Sort of two things. Firstly, just your comment on what Corrado is saying, that they're developing their own metrics. Presumably MSCI is thinking along similar lines. If you could cover that just fairly briefly. And then secondly, perhaps at slightly more length, Meggin, whether you are seeing an influx of new inquiries from potential new clients and what they're asking on S. So we've got leaders on this call, detailed comments from Wim and Corrado. What are the latecomers actually looking at? So two things there. Comment on Corrado's data and then the state of the market for the latecomers.
Mm-hmm. Yeah, so like Eurizon, of course, MSCI is constantly looking to enhance the model and the offerings and keep up with what the market is looking for, but also what we are able to extract in the way of new insights from data via new technologies and so forth. So human capital is very much top of mind for us as well in all of its aspects. I would put diversity in there as well, diversity and inclusion. So that's kind of the short answer there. And then your second question, has gone right out of my mind. I'm sorry.
Let's say I'm a really bad fund manager.
Oh, yes.
Now recognize S is important. What do I do? What do I ring up Meggin and ask for?
Well, there's what you should ring us up and should ask for, and then there's what people ring us up and do ask for.
Let's identify the bad guys. What do they ask for and what do they talk about, the bad guys?
I'd say there's kind of two streams there this year anyway. So we've seen a huge influx of inquiries about racial diversity. And that's very much in response to what's going on in the world, what's going on in the market, and asset managers who are responding to what the asset owners are thinking about, because the AOs tend to be thinking more deeply and thoroughly about this. They tend to have a much longer view, and then their managers are kind of scrambling to figure out what they can do. So that's kind of one stream, and that's been true very much in the United States, but we've seen it in other parts of the world as well. So it's not limited to the States. And then the other mainstream is, I would say, if you're talking about kind of the laggard asset managers coming to us, most of that is being driven by their clients. So it's them coming to us saying, all right, we've been told we have to do this. What should we sign up for? So there's that, but then you also have, especially in Asia, there's a real stream of investors looking at the latest evidence coming in, kind of the piling up of evidence through the pandemic that ESG strategies have performed well, and saying, we want in on that. What do I do to get alpha? So I said there were two, maybe that's really kind of three, but I'd say that's a lot of it in a simple way.
The common theme there is it's the end client. We're talking institutional predominantly, but it's institutional clients. And, in the UK, there'll be announcements coming out next week, which indicate, I think, the need for institutions to do more and their frustration that they can't always get what they want. So it's an interesting trend in the UK.
Yes.
What I'd like to do is if we sort of try and look forward now, and I've raised already, I think we have raised the EU taxonomy. I think both Corrado and Wim spoke about that. I'd like all three of you in turn perhaps to discuss what you think the outlook for S factors is going forward, and how perhaps they are, we move towards standardized definitions and standardized metrics. And what I'd like to do, Meggin, is leave you to last, since it's kind of your area of expertise. But perhaps if I go to Corrado first, you're developing your own intellectual property, which is great, but would you like to see greater definition and consistency? And do you think it's at all realistic to expect that to be global? And I'll put the same question to you, Wim, when Corrado's given his thoughts for a couple of minutes. So where next? What would you like to see as a user of S data, Corrado, the S concept?
I think that we definitely need a new standard for metrics to be published by the companies, because we already use all the metrics that are available thanks to GRI, SASB, and so on. And so we use metrics that are elaborated, for example, by Msci, that are embedded in our social risk score. But because of the lack of information provided by the company directly, we also need to try to find other source of information, with thanks to technology, basically, as before they say. And so I understand this is a topic that is not just for the S sector. I think that we need more transparent and standard way to report by the companies, and we need to engage them. We need to engage them because we need, as investors, we need to have the same to have the same language spoken by the companies for comparing information. No, I think this is a must, and we are committed to also to engage companies on this topic, but not only for S, even for E, even for example the new field of the circular economy, where we think there is scope to do a big job, especially in EU.
And at what level, you called for a new standard, your first remark on new standards. At what level should that be? I mean, what is realistic? The EU could probably do it. America, Japan could probably do it. But the chances of integrating even those three blocks to get a global standard, that must be many years away, wouldn't you have thought?
Oh, yes, sure. I think to have a global standard, I think we will need a lot of time. I think the best thing to look for is to have a regional standard, because in the end, the important thing for us as investors is that information are released in a very transparent way. Adopting a standard, even if the standard are 2 or 3, is not really a big problem, because we can manage different kind of information, knowing how this information is elaborated.
Okay, Wim, what's your position on this? What would you like to see happening, and what do you think is realistic to happen?
What I would like to see is obviously information, because the way markets operate is they can only price something if they have information. Otherwise, they can't do a lot. But in terms of the standards, it's a complicated issue, and to me, honestly, I don't think it's really an issue if you have two standards, like US developing their own standard and Europe developing their own standard. That's a completely different ballgame if you talk about 14 standards and adding on top of that the US and Europe standard. That's a real challenge, not only for us as investors, but let's think about who the stakeholder needs to report. It's the companies. So I think also companies are looking for some harmonization there, so that they can provide information in a uniform way that is in a uniform way, meaning that investors feel comfortable with, governments feel comfortable with, and that they don't have to report on 10, 20, 50 surveys a year where they need to address all these kind of issues. Now, we need to realize that standards are good. We really need them. So that, for me, is pretty obvious. It lies ahead. I don't know when, certainly not next year, but at some point it will be developed. But we need to realize that if you look at US GAAP and IFRS, which are the accounting standards, they are uniform for all sectors. When you talk about E, but also you talk about S, we need to understand that it will be different by sector. Each industry faces its own social issues. So it is not only complexity of which regulator, which government is going to develop what, it's also a matter of realizing that it will be different by sector, and the European taxonomy already gave a hint on where we're heading for. The taxonomy is clearly defining by sector which activity is perceived to be sustainable. Well, I believe that we will face the same challenge. Now, why do I put it as a challenge? The taxonomy already was quite a bit of work to be done, negotiation, lobbying. It will be the same for the S part, and it will be specific by sector. But what we need, just to make the point clear, it's clear that we need disclosure, we need information, we need to be able to judge what companies are integrating, how they do it, and there are different levels too in terms of reporting. Governance, most companies feel comfortable with. They are willing to talk about board diversity, they're willing to talk about independent audits, etc. But once you move a level below that, and you talk about employees, engagement, policies, safety, education, training, so a lot of stuff important, then you see that we're missing a lot of information for the investor to judge who is doing very good and who is doing bad.
Okay, so Meggin, if I ask for your comments on this, I think what both of our investor friends are calling for is more data and a degree of systematization, but everybody recognizing the complexity of the task. What are you seeing from your perspective as a sort of data expert? Are you seeing initiatives underway which you would steer us to? And are you seeing better disclosure by companies? Where do you think it will go?
We have over the years, I've been in this field for 20 odd years myself, definitely seen corporate disclosures improving over time, and much more so over the last several years, but still woefully short of what any of the leading investors are looking for. We're pretty agnostic about which standards or which regulations are best. There are so many. I think that the problem at this point is the proliferation rather than the specific ones, and possibly some of the mandatory regulatory moves like we see in the EU may start to bring a little more coherence to that if people start to coalesce around something. There's the classic problem where somebody looks and says, like, we've got too many standards. The solution is to make a new standard. I think we're seeing a lot of that right now, but hopefully that will sort itself out with time. Beyond that, I really have two main thoughts on this discussion. The first around company disclosures. We've been talking a lot about workforce issues, but social issues extend beyond the workforce, which I'll get to in a moment. But on company disclosures around human capital and labor, as I said, we're woefully short of what we would like to see there. But I think we also see even where the disclosures at companies where the disclosures are good and thorough, it still tells us what they're doing and not whether it's working.
Yeah.
And so I think Corrado mentioned earlier about trying to measure workforce engagement and that sort of thing, because that starts to get you to where you actually want to be. You want to know whether talent is being developed, whether it is productive, whether you're getting the most out of your workers. And that's extraordinarily difficult to measure. Is the company being innovative as it could be? I mean, really hard to measure, but that's where you want to get to. And so all of the disclosures are like kind of interim measures that get you a bit closer. but not all the way to the answer. So important for sure. I don't want to come off sounding like I don't think they're important, because they are. And it would help us get a good bit further along the road than we are now. But still, they're not an all-encompassing solution for what you really need to know as an investor. And then I alluded a moment ago to the idea that social issues aren't limited to the workforce. You know, we've got community relations, you've got kind of broader social unrest and inequality and kind of these big intractable issues. And I think one of the things that we're starting to see among some investors is an understanding that you have some really structural, systemic social issues that present risks. You know, they're an ethical problem also, things like income inequality or racism, but that they do in fact present systemic risks to portfolios. So risk to individual companies, people are going to come and say, you need to do this or you need to do that, or there's a lawsuit, but also something bigger than that. And that's where we see kind of the next frontier, so to speak, of investors looking at trying to find ways to grapple with that and look for more scalable solutions that can get at more of the root causes. So you see some coalescing around the SDGs. You've seen a real uptick in social bonds this year. I think those are some of the types of experimentation that we're starting to see to get around that. So I guess if I were to sum up, you know, there's the data piece of this, which is where we started. But data will only get us so far, because some of the things that we need to deal with to limit risk or to bring it back down go beyond individual companies.
Yeah. It's very interesting. I think you all three, I think both Corrado and Wim have just echoed something you said, Meggin, which is you need something beyond the data. It is the engagement. You know, how do you check whether the workforce is engaged and supportive and content? And how do you report on that? I think all three of you have addressed that in the context of intangible assets and so forth, and how the data providers, how the fund managers are able to ascertain that in a credible and replicable and scalable way must be one of the real challenges here. And I think just talking to your point about systemic issues, I remember being struck, if you look at the relative performance of the oil production sector, the oil producers over the past decade, it's been absolutely terrible, and it coincides and it's been driven, you know, with the rise of environmentalism. And, you know, clearly there's a great deal of alpha potentially linked to S issues if we're going to see swings of that magnitude. So we're beginning to come to the end of our time. What I'd like to do is just go around all three of you, again, starting with the fund managers, and just asking for a kind of prediction on how important S will be. And we've covered some of it, linking it, you're saying S must be linked to E, but, you know, are we about to start the decade of S, if I can put it in that kind of provocative, high level way? I'll come to you first, Corrado. Is S what you're going to be talking about more than E, more than G for the next decade, both as the concept, the socializing the concept with clients, and then repeated conversations about implementation? Is this the decade of S kicking off, Corrado?
I'm not sure, but for sure, S will rise its importance compared to what it has until now so far. So I think S will have a bigger role in both in the way we judge companies, and both in the way regulator will try to resolve environmental issues. So I think we need to look at the sustainability concept in a more holistic way. This is what I think the sustainability for the next decade. I think we need a more holistic way. We cannot just pick one of the three, and environment, social, or governance, and then let the other alone. Because the lesson is that we need to integrate environmental and social dimension. It's the story of the last decades. You see, for example, we have to address social issues in another big transition that we need to do in the next decade. I think the next decade will be the decade of the circular economy, because the EU has led the way to this field. And the International Labour Organization, the ILO, has projected the circular economy can create new jobs for about 7 million jobs to the 2030. And of course, but this will be not just as plus 7 million, it will be the results of destroying more than 70 million jobs in the linear economy and creating 78 million jobs in the circular. So it's clearly an issue that will be needed to be addressed both by the regulators and also as for investors, we need to look at how the social issue is managed by the companies. And so we need to have information in order to judge what companies have a higher degree of success. And at the same time, we need to have information to engage the companies on societal issues. But I think
I'm going to have to cut it off there, Corrado, to let the other two just have their final remarks. Wim, I'll come to you next. I put the idea it's the decade of S. Corrado has already corrected me. What is the next decade and what role does S play in it?
The next decade will still be about E. I'm pretty confident about that.
That's very interesting.
But to be very concise here, it will still be about E, given the challenges that we face. Climate change is a massive challenge. But what I believe is, to Corrado's point, is there will be more integrated thinking. I think COVID has clearly made people aware, certainly regulators, that they can't just reduce the S part to one line in the preamble of whatever kind of agreements. So for me, climate or whatever, E will remain very, very important for the next decade, certainly given the challenges that we face. But like Corrado said, there will be more holistic thinking also from a regulator and investor perspective, and considering that as for us, a more integral part to sustainable investing. Yeah.
No, good. And Meggin, you started us off. I'll let you finish us. The next decade of S from your perspective. What do you think?
I'd say I have to side with Wim. I think climate change is going to continue to be the issue for at least the next decade. That being said, I do think Corrado is right that there will be more integrated thinking, and that at least among the more leading investors and regulators, that the social issues, the just transition concept will be somewhat more integrated. As for how prevalent the concerns about S remain, I think that's going to depend at least in part on how the economic recovery goes, and whether the acute edge of inequality and suffering that we're seeing now, if that gets dulled back down, then even though your underlying problems remain, I suspect that they may kind of go back to being a little more of a back burner concern while people attend to climate change first. On the other hand, if the economic pain that we're seeing as a result of the pandemic really becomes entrenched, then perhaps there would be a different dynamic. I'll leave it there.
Yes, okay, well, we'll have to wrap it up there. Our time is up, but I've really enjoyed our conversation. The scale of the S problem, Meggin outlined at the beginning, 400 million job losses, racial issues to the fore again, rightly. And then Corrado and Wim, the discussion about what fund managers are seeing and thinking, the role of regulators, the need for more data, the need for more disclosure, and the need for a more holistic approach. And that holistic approach, it's what my team at UKSIF used to bang into me. I like the world to be simple. I do quite like ESG. I like a focus at a session like this on one of them. But yes, the future is clearly holistic, more data. And as I say to the UK regulators, it's going to cost more. We need more data. We need more staff to analyze the data. So there's a lot coming down the road. We focused on the S, but there's a great deal coming under the SRI banner, full stop. At that point, I'd like to thank our panelists, Meggin, Corrado, and Wim, and I'll hand you back to the next, I think it may be lunch, I'm not sure, but I'll hand you back to Etika to run the rest of the session. Goodbye, everybody.